Hello and welcome to the 7th edition of our Investment Insight series, Magellan Minutes. My name is Amy Krasanovic, I'm the Head of ESG at Magellan, and today I'm joined by David Costello, Portfolio Manager. Thanks for joining us, David. I'm really looking forward to the discussion today.
It's my pleasure.
David, today we'll be discussing climate-related risks and the drivers behind the increased focus from investors on achieving net zero by 2050. We'll also discuss the opportunities and the significant amount of capital being invested. So David, net zero is not a new ambition for governments and companies. In fact, over 90 countries have set net zero emission targets, and many of the companies in our portfolio have also set emission reduction goals and allocated significant capital towards the transition. I'm really interested in why it's become more of a focus for equity investors.
Amy, the equity market's focus on this issue reflects a growing recognition that the energy transition is likely to exert a significant and in some cases decisive impact on the business prospects of certain companies. And I can't overstate the significance of this transition. For hundreds of years, we've powered our global economy with fossil fuels. And through the Paris Agreement, the world's policymakers have committed to fundamentally rewire the world's energy systems, and to do that in a period of approximately 30 years. So for businesses whose business model is incompatible with a low-carbon economy, the realisation of that vision represents something of an existential risk. Indeed, analysis by the International Renewable Energy Agency, IRENA, suggests that in a scenario where global warming is limited to less than 2 degrees Celsius, that there's likely to be some $12 trillion of assets, principally upstream fossil fuel assets, energy infrastructure, and inefficient building stock, that is stranded. And they warned that that total rises to nearly $20 trillion in scenarios involving delayed policy action. Conversely, for companies whose products and services enable the decarbonisation of the global economy, the energy transition represents an unprecedented opportunity. IRENA estimates that limiting global warming to 1.5 degrees Celsius will require cumulative investments totaling $150 trillion over the period to 2050. Now, the most recent analysis by the International Energy Agency suggests that this year we're on track to spend approximately $1.7 trillion globally on clean energy technologies. But to achieve that vision of $150 trillion of cumulative investment would require an annualised run rate of investment of more than $5 trillion per year over the next 30 years. So we're talking about a nearly threefold acceleration in the current rate of investment. Now, there is an ambition gap. We're not currently on track to limit global warming to 1.5 degrees. And so we can have a debate as to whether or not that 150 trillion, nearly 5 trillion a year, is the right number to size the magnitude of this growth opportunity. But Amy, I'd suggest that that debate risks missing the forest for the trees in some respects. Because the analysis from IRENA suggests that even in scenarios where the world just funds its current climate commitments, that requires investments totaling $103 trillion over the period of 2050, which still represents an approximate doubling of the annualised run rate of investment required. So in all scenarios involving meaningful climate action, this is likely to be a significant growth opportunity.
Wow, those estimates of the opportunity set are really significant at US 150 trillion or even at that lower end of US 100 trillion. Why do you think this ambition is actually going to be realised?
We see three coalescing factors that are coming together to support the realisation of these growth opportunities, providing momentum to the energy transition. And those three factors are the rapidly improving economics of clean energy technologies, evolving societal standards, and regulatory and fiscal policy tailwinds. So let me unpack each of those factors briefly. If we begin with the rapidly improving economics of clean energy technologies, we've seen over the last decade dramatic reductions in the technology costs, approaching 90% for solar PV and nearly 70% for onshore wind, that mean that renewable energy is now invariably the cheapest source of new electric generation in most major international markets. Indeed, these cost declines have been so significant that in a number of markets, the full levelised cost of renewable energy firmed with gas or battery storage is now below the marginal operating cost of a fully depreciated thermal power plant. So the coal that fires a coal-fired power plant, for instance. And those technology cost declines haven't been limited to renewable energy. So analysis by Bloomberg NEF, for instance, shows that the weighted average cost of lithium-ion battery packs used in energy storage and electric vehicles has declined by approximately 80% over the last decade. An analysis by the Australian government organisation, the CSIRO, suggests that the costs for hydrogen will follow a similar trajectory. They project that the cost of a proton exchange membrane electrolyser to produce green hydrogen will fall by approximately 60% over the period to 2030 and by nearly 90% over the period to 2050. So that's conferring this transition a certain economic or commercial momentum. Now, supporting that is our second factor, evolving societal standards. And here we see that research from the Net Zero Tracker, a collaboration between research organisations, climate think tanks and Oxford University, shows that 89% of the world's population and 92% of global GDP is now covered by national level net zero targets. And 929 of the Forbes 2000, the 2,000 largest companies in the world, have now enunciated net zero targets. And ultimately, Amy, those targets are a manifestation of the will of the constituents of these organisations. The electorate in the case of government, and consumers and financial market participants in the case of corporates. And all of these constituents are demanding accelerated action on climate change. Now that leads nicely to our third factor, where governments have responded to this impetus for action by putting in place increasingly powerful regulatory and fiscal policy supports. Now, of course, this is most prominent in the United States in the case of the Biden administration's Inflation Reduction Act, which provides unprecedented support for clean energy technologies across a diverse array of vectors and industries. Now, that legislation was initially expected to cost the US Treasury somewhere in the region of $400 billion. But because the legislation was drafted in a manner where the key provisions are uncapped in the total quantum of credits that the government will provide to the private sector, it's now estimated by Goldman Sachs that the total cost to the Treasury will be approximately $1.2 trillion, and that the measures will crowd in total investment of more than $3 trillion over the next decade. And the European Union has comparable ambitions. The EU Green Deal seeks to mobilise more than €1 trillion of investments for clean energy technologies through the provision of public guarantees and subsidised loans, tax credits. And more recently, we've seen the passage of the Repower EU policy package and the EU Green Deal industrial plan for the net zero age, which adds even further momentum. We see similar measures in China, in India, in Japan. So together, those three factors, the rapidly improving economics of clean energy technologies, evolving societal standards demanding increased action on climate change, and the policy response in reaction to that demand, giving increasing momentum and realising these growth opportunities.
Thanks, David. So it really shows that as these companies and economies and industries transition, that it creates significant opportunities. So I was just really interested if you could talk about an example maybe of an industry or a company that is a real beneficiary from these opportunities.
Yeah, certainly, Amy. We're seeing really interesting opportunities at the moment in the electric vehicle ecosystem and value chain. And the electrification of the drivetrain in a passenger vehicle requires vast increases in semiconductor content. And that's really driving the results of one of the companies we invest in the Magellan Energy Transition Strategy, onsemi. Now, onsemi recently pointed out that the value of their semiconductor chips in an internal combustion engine vehicle is approximately $50. As we transition to electric vehicles, the value of their content has increased to $750, so a 14-fold increase in the value of their content. Now that's expected to drive a nearly 20% per annum compound annual growth rate in revenues for the company's automotive business, and at a group level, 10 to 12% revenue growth, supporting mid-teens operating profit growth and an expected doubling of free cash flows over the next 5 years. A very compelling opportunity and a clear beneficiary of the energy transition.
Yeah, the electric vehicle industry really is exciting and seems like there's a lot of opportunities, not just from the manufacturers, but as you talk about the value chain there. Really interested in maybe some more unexpected examples or interesting examples that you've come across that are also taking advantage of the opportunity.
Yeah, some of the most interesting examples we've come across exist at the interface between technology and decarbonisation, in particular in the industrial application software space. And one company that we're excited about in this space is a company called Ansys. Ansys develops engineering simulation software. Effectively, they use very complicated physics and a lot of computers to predict how products will behave in the real world and to optimize their design. Now, the need to design increasingly innovative products with vastly improved sustainability characteristics is driving increased demand for Ansys's software platform, particularly from companies in the aerospace and defense sector. And I thought I'd highlight two recent examples that demonstrate the power of the company's platform to drive these sustainability characteristics in a manner that's growing the company's earnings. The first example involves a collaboration between French jet engine manufacturer Safran, actually a holding in the Global Fund, and Ansys. And Safran has used Ansys's thermal and structural simulation capabilities to design a new generation of jet engines that dispenses with the nacelle or shroud that surrounds a traditional jet engine, using an open fan architecture, employing novel material science and hybrid electric capabilities to deliver expected dramatic reductions in the carbon dioxide emissions associated with air travel, approximately 20%. Another recent example, which I think is even more compelling, involves Ansys customer Lufthansa Technik, also in the aerospace sector, designing a film that's applied to the underbody and fuselage of its aircraft that mimics the aerodynamic properties of shark skin, again, reducing drag, enhancing aerodynamics, and reducing carbon dioxide emissions associated with air travel. So a powerful example of technology delivering these decarbonisation objectives in a manner that supports financial outcomes.
Thanks, David. That's been a really interesting discussion and really appreciate your insights, not only into the risks from the climate transition, but really exciting about the opportunity set there and how we can access that as investors. So thanks for joining us today.
Thanks, Amy. It's an exciting area.
And thank you for joining us. If you have any queries, please don't hesitate to reach out to the Magellan distribution team and feel free to share this recording with your clients and colleagues.